Show Me the Money Fundamentals of Fundraising. We've got two dynamic speakers for you here in this breakout session, Dr. Juliana Iarossi and Josh Sneed. And they are two people who need no introduction, but let me plug them for just a second. Dr. Iarossi, after earning her MBA, spent more than 25 years in financial services, driving capital to businesses, building investment portfolios, and turning around troubled businesses. She left industry in 2006 to focus on the venture community and work on her doctorate. Dr. Iarossi is an active angel investor, speaker, panelist, and judge for startup events and advisor to businesses, accelerator programs, and other initiatives related to entrepreneurship and innovation, both in the U.S. and Europe. She is an advisor and board member to founders and CEOs of early stage ventures and serves as chairman of Venture South Investment and as a member of the board of the SC Launch, Inc. As a clinical assistant professor at the University of South Carolina, teaching courses focused on corporate, financial, and innovation strategies in the Business School and College of Engineering. Dr. Iarossi is educating the next generation of business leaders. She has a BS in Materials Engineering from Virginia Tech and an MBA from the University of Texas at Arlington and a doctorate in business administration from Georgia State. She is accompanied by Josh Sneed, and Josh has worked in insurance technology for 9 years. Prior to co-founding Rainwalk 5 years ago, Josh served as an account executive for Guidewire's data and analytic products, delivering industry-leading data and software solutions for carriers across the United States and Canada. Before Guidewire, Josh worked as a manager in Capgemini insurance practice, leading a wide array of both internal and external facing projects. Prior to Capgemini, Josh worked as the leader of a strategic projects team for small insurance tech consultancy, which grew from 17 to 400 employees in just 3 years. He successfully exited via an acquisition by Capgemini. Josh attended the University of South Carolina, go Gamecocks, and graduated with a degree in international business and supply chain and operations management. Please help me welcome to the stage Josh Sneed and Dr. Iarossi.
Check, check. Can you guys, you can hear me?
Hello? Is this working? Can you hear me? Can you hear Julie, though?
Okay. You can hear me? Yeah? Good. Well, thank you guys so much. This is pretty awesome because now we can say that Hootie and Blowfish was our,
Our intro band.
Opening.
Yeah,
they were
exactly,
our
our
opening
opener.
band, so this is kind of cool. So neither Josh nor I sing, so we're going to spare you from that, which will be, or dance. You don't want to see that happening. So just to add a little bit, I got my start early in my career with a technology startup 100 years ago. And so I have spent about 40 years in different capacities seeing CEOs, founders, CFOs fundraising. And there are a couple things that I observed in that. First, fundraising is a time suck. It just takes over your life, right? The other is it can be mentally and emotionally exhausting. But the worst about fundraising is it usually takes founders and CEOs away from what they really love and what they want to do. And that's delivering value to the market, building companies, solving problems. And so this process that can crush you doesn't have to. And it shouldn't, because fundraising is usually not a one and done, right? You're in your second?
Yeah.
Yeah, so it's not a one and done. And so you got to find a way to be a successful fundraiser, to actually enjoy, maybe that's not the right word. We're going to try and put a little bit of the fun back in fundraising. And I think Josh I actually met Josh maybe 10 years ago at a Startup Columbia event. So you have been focused on this idea of being a founder and building a technology company. And for my business students, you can be a technology founder with a business degree. And so one of the things, we're going to be talking about a lot of different things today. We're going to split it up into kind of two sections and try and take some questions in between. And we're going to focus first on the preparation for fundraising. We'll focus really on that first time that you're out there raising money. Take a couple questions and then go into what it looks like when you're actually in the hot seat trying to pitch your idea, right? So a couple of things, just from what I've seen, success in fundraising really requires self-reflection. This kind of harkens back to things that Jim Sonnefeld had said, some self-reflection, right? They didn't say no to you because you have a tattoo, right? So we've got to really look and not live in this world of denial that what is that? It takes humility, figuring out, okay, how could I have done it better? And also the ability, the willingness and the ability to really seek advice and take that advice and improve each step of the way. Because again, the way you start off, we'll talk about, you learn a lot along the way.
Yeah.
So it's me and Sneed, right?
Yep. Hey, can you hear me? Yeah, I can hear myself now. Cool. Yeah, and by no means do I claim to be the world's foremost expert on fundraising. I was very fortunate to have some people teach me some really awesome fundamental stuff, and then, of course, learned several things the hard way. So my hope is that either it's interesting or maybe a little helpful, and you can kind of skip some of those things that I had to learn the hard way.
So let me ask you a question starting off. So how do you know when you're ready to fundraise?
Yeah, so there's a couple things that go into it. You definitely want to know, there's your side and then there's the investor's side, because you need them both to line up. On your side, you should know what you're going to spend the money on. And I know that sounds kind of simple, but you'd be surprised how many people walk into an investor's office and ask for like hundreds of thousands or maybe even millions of dollars and don't actually know exactly where that money is going.
And as an investor, that's a baseline question we always ask is, what's this money going to use and what's it going to turn into, right?
Yep. And it implies that you don't really know where it's going, and that's, of course, a huge red flag for them. You're going to want to make sure that you actually are going to get a good return on that investment, too. Nothing is worse than, it's going to be hard to raise the money to begin with, but once you raise it and you spend it all and you don't actually have the business outcomes that you were hoping to gain. So that makes it even harder to raise money the next time. So even though you kind of really have that urge to get that round closed and get that money in the door, many startups have failed from getting too much money too fast.
Yeah.
Not as much as have failed from not having the money, of course. But
Well, when you've got money burning a hole in your pocket, you want to spend it quickly, right?
Yep.
So.
Exactly. And if you don't spend it quickly, the investors are like, why'd you take it from me then? Why'd you raise it so early if you didn't need it? So definitely do a lot of thinking on your side, on your company, on your idea. Where is it really going to go? And if you don't need $1 million, if you just need $100K or $200K, then maybe start there and then get the rest later. But just as important is the investor side, because remember, they're not investing in you purely out of altruism, right? Like they're expecting a return. Like you need to be
Not
building.
at all out of altruism.
Yeah,
We're looking
exactly.
for returns, right? Yeah.
So having a very clear idea of how they're going to make their money back and really understanding how much money they want to make back. I mean, I was surprised realizing just how big an investor expects a founder to build a company for them to get a return that's exciting. You know, if they're looking for you to build $1 billion company, but your business plan only gets you to 50 million.
Or the market size is only 300 million.
Yeah, right. Then there might not be a fit there. So there are investors who do want to invest in those kinds of smaller markets, but you don't want to spend your time and their time pitching somebody who needs $1 billion company when you don't want to build.
So how do you find the right investor?
It's tough. It's tough. There's not really like a central repository for where to go to find all of these investors.
Yeah.
The one that I found the source that I found the most investors from has been my existing investors. And I know that that's a bit of a catch-22, but it really is kind of a snowball. You want to try to find some early allies. Usually where you start is what we call angel investors. So those are high net worth individuals or people who have money and they like to invest in startups and in new founders. And then often those people, if and when you can demonstrate that you're building something awesome, that they think it's awesome too, you get them on board, even if it's a small amount of money, right? It might be $10,000, $20,000 and you've got your eyes on $1 million. But those people have a lot of companies they invest in, and they know who they're co-invested with. They introduce me to a lot of the venture capital firms that actually write those bigger checks. And then you've got a warm intro, right? You're not some stranger off the street that they don't know from anybody. So now how do you get started on that flywheel though? It is tough. It takes a lot of time. I use Crunchbase and PitchBook. These are two online repositories for investors and companies that they invest in. I wouldn't probably pay for subscriptions up front because they can get kind of expensive.
Well, PitchBook's like 50 grand, so.
Yeah, that one's the enterprise grade one for sure. But ask other founders as well. That's why events like this are super important, because you get connected with other founders and then you're like, who'd you go to? Who was a great early ally for you?
Yeah, the peer-to-peer entrepreneurial communities are great because other founders can tell you, you know what, they don't really invest in these type of deals. Why don't you try and talk to these people? So, and actually for angel groups, I mean, I've been part of one of the largest in the country and have been part of multiple angel groups. But a lot of times our greatest source of deals comes from other founders saying, hey, I know this guy, and so that's a positive. It's just that connection after connection. So
it's all warm intros. I mean, I know that isn't necessarily easy to accomplish all the time, but I've always felt like the cold introductions has just been so high effort, and so often it doesn't yield an actual conversation or an actual introduction. Just because someone sees a PowerPoint that I created doesn't necessarily mean that they understand me as a founder.
Or understand the company.
Or what we're trying to build, or how it works.
Yeah.
So
let me ask you, what were some of the things that you had to learn that were kind of outside of your purview, of normal life, things you have to know just for fundraising as a technology company?
Yeah, so I had never raised money before, Rainwalk, so this was a lot of learning exercise here.
Well, let me ask, has anybody here raised money for a company? So we've got some hands up. Oh, there we go. Right? So you guys can chime in the Q&A and kind of share some of your experiences. So
yeah, the first thing that struck me was the language, like the way that investors
speak. You know what a deal room was?
Not until it was too late.
Yeah.
But no, just understanding what they meant by certain words, and not only that, understanding what I was signaling to them by saying certain things. Investors, by definition, are not experts in everything that they invest in. So they have to identify patterns that identify successful companies. And so you want to make sure that you're not accidentally stepping in a pattern that is a red flag for them as investors. So for example, if I might say something like, oh yeah, I think I can build a lifestyle business out of this. Well, for a lot of investors, especially venture investors, that's a red flag. Not that there's something wrong with building a lifestyle business, or another thing might be, oh, well, we might never sell this thing. It's like, well, that might be true. You might never sell it, but the whole purpose of an investor investing in you is to one day sell it and get a return.
This happened at a meeting I was in, group of investors, founders pitching, and we noticed there was no slide on the exit. What is the potential for exit? And the founder said, oh, I'm not planning on selling. And there was this collective gasp in the room. It's sort of like, why is this guy here then? Because without some exit, we're not sure how we get our return or our money back. So
yeah. And again, there's nothing wrong with these businesses, but when you think about seeking outside capital, especially from an institutional investor, like a VC of some kind, a venture capitalist, you've got to be really sharp on that.
Well, you have to match the type of funds that you're looking for and that source of funds with what you're doing.
Yeah,
right?
exactly.
Not every source is applicable to every type of company.
Right. So very important.
So what other language was there that you
Yeah, so there's all sorts. So it's essentially like a vocabulary test that you have to take initially. And I won't bore everyone with the super
We
details,
can create
but
a card game and sell it.
I got one business already. We'll
Yeah.
work on that one after. But like acquisition costs or cost to acquire customers, investors will call that CAC, C-A-C. And it's a very key term for them. And then there's LTV, lifetime value of your customers. So we as business owners very intuitively understand what these things are when we read the definition. But often for me, early in the investing process, someone would ask me, oh, what's your LTV to CAC ratio? And no matter what you say, unless it is a very precise number that you speak confidently, they immediately say, oh, well, okay, this person doesn't know what they're talking about.
Yep.
And it's not necessarily that they're holding it against you. It's just they see hundreds, sometimes thousands of companies pitch
Yeah.
them every single year. And some of the bigger firms might even see that every month.
Yep.
And so they just do not have time and do not want to take the time.
Yeah, so you've got to learn that language.
Exactly.
What's the valuation cap? What do they
Yeah.
mean when they say CAC? What do they?
Yeah, and I found that I was wasting my time unless I took the time to invest in that up front. They'll take the meeting. I mean, they'll meet with
Yeah.
you all day long every day. It's not necessarily their time you're wasting. They do this for a living. It's my time.
In preparing to fundraise, what's the best advice you received
Ooh,
for that first time you raise funds?
it's a great question. It's always about the story. No matter how great your slide is, no matter how great your financials look, ultimately, even if you don't have some of that other fundamental stuff, if an investor or a human is not bought into the story and the mission that you're trying to accomplish, like that has to be right. Like that's
Yeah.
the precursor to everything. Then you can start getting the fundamental basketball right. But
Yeah,
you got to have the story.
And this is an interesting point because I know for angel investors like myself, you've got about a minute, even though you might have 10 or 15 or 20 minutes to talk about your company, you've got about a minute to either pull up my heart or my wallet, or hopefully both, right?
Yeah.
And if you don't, or if after your pitch and this discussion, when you leave, I've been part of this, we're like, what did they do again? This is a problem. So really,
Yeah.
so knowing, being able to create that story, that makes sense. What's
Yeah.
the worst piece of advice?
Ooh. I'd say trying to get an investor to invest in you when they don't invest. So for example, for us, it was like, oh, this insurance company would be a great partner, great investor in your company. Well, have they ever invested in
Yeah.
any startup before?
Yeah.
Oh, no, but I think it'd be a really great fit. It's like, I appreciate the introduction,
Yeah.
but I've tried that so many times and never once have we even gotten close to getting a deal done. It's just, if people aren't investors, they just have a really hard time getting over that hump. Their executive teams take a long time to make decisions, and then they ultimately end up walking away. So strategic
Yeah.
partnerships are awesome, but if your ability to make payroll or maybe your ability to build the company at all relies on some often bureaucratic process with 7 different executives
Yeah.
to agree, and they don't do this all the time, it's a lot of risk for you and your company. So, pros and cons, right? A traditional investor, whether they're an angel investor or an institution, probably is not going to understand your industry, not going to understand the problem. And that is probably going to be a little frustrating for you because you're going to have to bridge that gap as a founder. But non-traditional investors are even harder to get to write a check. So I would say just if you're going to take money, learn the rules of the game, get your story right, and go to people whose full-time job it is to write checks to give you money.
Did you practice?
Oh, a lot, yes. Nowadays, I try to do about 10 to 15 before I start a fundraise of just practice to someone non-committal. So someone who's not going to even have a chance of investing in me, but who has either heard pitches before, maybe it's one of my existing investors, and just for me, that's been the number, about 10 practice sessions. After that, you're still learning, you're still growing, but you're practicing on the job, if you will. Some people can go the other way where they practice too much and they never actually get out there in front of investors. So at a certain point, you got to rip the Band-Aid off, you got to just get out there. But you also don't want to not practice at all because like we discussed earlier, it can be hard to find investors initially. So you want to make every at-bat worth
What
it.
about your pitch deck? Are there certain slides in the pitch deck that you absolutely have to have, or?
Yeah, and I would say only have those. So initially, when I first started raising money, my slide deck was really long. I didn't realize it was long at the time, but it was like maybe 25 slides
yeah, that's
long.
long.
And see, yeah.
Yeah.
But now I've narrowed it down to about 10. For me, I felt like the really compelling part about our business was the business, was our team. So I wanted
Yeah.
the slides to be there as a tool, but it wasn't about the slides. It's a distraction. In fact, some pitches, I show up with the slide deck. Sometimes we don't even look at it. Sometimes we
Oh,
don't
wow.
even pull it up because the investor just wants to talk. They just want to learn about us. They want to learn about the company. They want to ask critical questions.
Give us the couple minute of what your company does.
So I start off every pitch with the same little spiel.
Yeah.
My name is Josh Sneed. I'm the CEO of Rainwalk. We're an embedded pet health insurance company. We provide high convenience, high trust purchase experiences at point of sale, exactly where it matters for pet parents. Specifically, we started with adoption shelters, so we embed a one-click purchase experience at point of adoption in adoption shelters and rescues. And then this past summer, we launched an employee benefits program where now we're
Yeah.
providing similar high trust, high convenience purchases, but in your employee benefits package, side by side with your medical, vision, dental, pet insurance.
Excellent.
So that's why I start off every
Yeah.
time. It's
Yeah.
like a safe space. It's
What do
like
you
a
think?
nice little foundation.
You guys know what he does? Yeah, right? So any questions right now as far as just the preparation part of, right before you make that first pitch? Any questions for anybody? But I can't see the crowd that well, so. Yeah.
Do you have like some resources or are there programs that help you to get ready for fundraising or learning about how to create a pitch deck or things of that nature?
Yeah, so for me, there's a lot of different places you can get that guidance. But for me, I received it going through the Techstars program in Austin. So I had a mentor of mine connect me with the managing director there. We applied. We ended up getting into that program. And they had a pretty rigorous 3-month process where I literally moved to Austin, went through that program. And that's where I learned a lot of that foundational
Yeah, so the
knowledge.
accelerator programs,
Yeah.
if you can get involved with accelerator programs, they'll be focusing very heavily on
Yeah.
that.
So that was where I found it as a first-time founder. A couple of other good sources would be other founders who have raised outside capital before, if they're willing and able and they have the time to sit with you. Also, investors, even if they don't invest in you, and even if maybe you don't feel ready to take their capital, they can also kind of help you, probably not for a 3-month stint necessarily, but 3 sessions over the next 3 weeks. Would you be willing to meet with me on Tuesday? I'll buy you coffee. And
Yeah.
just, here's kind of what I'm thinking, what's compelling, what's not about that.
Yeah, also angel groups, a lot of times angel groups in the cities that you're in will have kind of pitch 101 sessions. I know Venture South, we've got this going on all throughout the year, so founders can see from our perspective what we expect to have on that. There's lots of online resources, but I would look into that entrepreneurial community, see if there's accelerator programs. They don't have to be 6 months. Some
Right.
of them are week-long boot camps, things like that, that can help you understand. And of course,
Yep.
really invaluable to hear from founders who have done it before, because they'll say, I went in with a 60-slide deck and we got through 3. And so,
Yeah, absolutely.
yeah. Other questions? Yes, there's.
So something you said is that you have to connect either investors' hearts or the wallets of one of the what part would you say is research or background, just to understand the person? What part would you say do some research and how much time do you invest into and what is important to learn about this?
Yeah, absolutely.
So you want to talk about how did you research?
Yeah.
it?
So it's a little different if it's an angel investor who is truly just a human deciding what they do or don't want to invest versus maybe a more institutional investor, maybe an organization. They might have a committee, people who are making the decision. But before every investor pitch that I do, I always look up what they've invested recently. If there's any information about them online, I always look them up on LinkedIn. Any name
Yeah,
that's on the
because you can
invite at
usually
all.
see on their websites too, what are
Yep.
the deals, what are the type of deals they've done, right?
Yep. And I try to find some way to connect. In my experience, the hardest part is the beginning, like just getting over that awkwardness, building that rapport, connecting with them. So I'll look and I'll see, oh, they went to the University of Iowa. Well, I spent a couple months in Des Moines a few years ago. So I'll bring that up, like, oh, hey, I see if you're from the University of Iowa. So simple stuff, it takes like 60 seconds, but that research really helps you kind of bridge that initial awkwardness gap. And go from there. Beyond that, though, you do kind of have to think on your feet.
And I can see on LinkedIn when founders that are going to be
when they look you
pitching,
up.
I can see on LinkedIn that and I'm like, oh, that founder is going to be pitching to us, in a couple of weeks.
Yep.
So
And how do you feel when you see that? I mean, if anything,
actually, that's good
Yeah.
because now they're looking and understanding what's the background, what's the level. One of the big things you want to see, what's the level if it's a very technical type of product or service, what's their level of understanding of that? That's really important. Do they come from a consumer products background? And so you want to kind of look and see and gauge how much detail or how, is it a group of doctors that are investing that you're going to be pitching to, and it's something in digital health, then you can use a lot certain language. But if it's a broader, group of investors, be really careful using certain industry-specific lingo because we'll sit there and what we're going to be doing, and I've had to do this a lot on my phone. I'm looking up what these, what these terms mean.
Yep. And while they're looking up those terms, they're not
listening to you.
So it can be tough, especially like in insurance. We have a lot of terms, a lot of just random vocab that you would never know unless you really worked in insurance. And so trying to find a way to be accurate and be genuine, but still not use these terminologies that are going to really distract from your messages.
Yeah, unless you're pitching to an insurance
Exactly.
venture fund, right?
And then you do the opposite, where you just lean into all the vocab, which demonstrates that you know what you're talking about, and you get to hurry along the intro parts. You get to jump straight to the meat of the topic.
Yeah.
So and I think to kind of answer your question specifically, you can do some research, and you should, and that definitely helps, but it is a lot of on the fly. It's a lot of improv.
But using things like LinkedIn and doing searches on who these investors are, going to their website, seeing the deals they've invested in can help you gauge whether are you a good fit and what level you should be speaking to them at. So,
although I will say, every time I've ever raised money, I've taken a meeting with everyone who will take it. So it's not like I was like using that to, hey, if you'll take the time, I'm going to pitch you.
Which brings me to a point, how many investors in your first round, how many investors did you reach out to? How many did you pitch? And then how many invested?
Yeah. So the first time we tried to raise money, I did no prep. I had not gone through that TechStars program yet where I'd gotten kind of a foundational level of knowledge. I ended up pitching 170 investors in order to raise $225,000. So it seems like a lot of effort to money ratio, which it kind of was.
I heard that from a friend of mine. I said, how many have you gotten in touch with? He was at the beginning, he was wrong. He said 115.
Yep.
And I was like, good, because when I hear and talk to those founders, I said, oh, this is not working out. I'm like, how many people do you pitch to? 5. I'm like that's just today. How about who's on your spreadsheet? Who's on your list? What have you, and
so
it's a lot of work.
Now, the number that I hear, even from experienced founders, is about 100. Any given round that you raise, whether you're raising 100 million or 1 million or 100K, generally speaking, you're wanting to plan for pitching about 100, and then if you do it quicker, awesome.
But the second round, are you pitching to as many, or are you staying with a tighter group?
Every time. Maybe really late stage, just the number of people who write really big checks like that gets smaller, but I'd say for those pre-seed, seed stages, when you're talking about angel investors, anywhere from 100K to $10 million that you might be looking to raise, it is a lot. I mean, it's 100 at least. And so now, to be fair, the first 60 of those is me refining what's actually working and what's not. And
so maybe don't do your A-list in the very beginning, right?
Right. But I think for me, I really felt like, well, if the pitch that I gave on pitch 100, I had given on pitch 1, it might have been way, way faster. But don't discount the learning that you will do through that process.
So tell us about the best investor meeting that you had, where things just, it clicked. And then compare that to the worst meeting that you had.
Yeah.
What?
So my favorite ones, and this does not happen very often, but my favorite ones are, hey, we really like InsurTech and we invest in InsurTech all the time, and we've been really looking for the right partner to get into the pet space, but we just don't like A, B, C about your competitors. And then I say, perfect. The entire premise of our model, what makes us different from our competitors, is A, B, C. And I think that's really, I'd say,
But
the ideal.
that's because you did good customer discovery, right?
Yes.
I mean, you understand the market, you understand the problem, you understand your competition
Yeah.
really well.
And you need to be able to speak to that because, they're going to throw a million questions at you. And that's another thing that you learn through that process is, investor one, every question that they ask me, I've probably never heard before. But when I get to investor 20, investor 40, they really all start asking the same questions. So what that gives me the opportunity to do is get really honed in on what an awesome answer is.
Yeah, and I've seen founders see those patterns and questions and add it to their slide deck, not
Yep.
to present it, but when the question's asked, they're like, oh, I have a slide for that.
Yeah, exactly. It's down in the exhibits. Imagine the wow factor that you can deliver when someone asks you a question, you're like, oh, glad you asked. In exhibit B, I have a whole model that describes exactly that. So
Yeah.
these are some of the ways that really help you stand out and kind of push someone over the finish line on whether
Yeah.
they're going to invest or not.
What about when you walked out and you were like, nothing, they're not going to give me,
Yeah.
they're not going to pay for my park, and they're not going to even.
Yeah, we're not going to lunch after
Yeah.
this one.
Nope, no lunch.
No, those do happen. I think for me, usually it's whenever I think about when those have happened, it's because for whatever reason, I wasn't in the right state to really give a good performance there. So I still, of course, feel very optimistic about my business, but maybe I missed lunch, had a couple coffees too much, and I'm kind of jittery and anxious, or like I didn't get as much sleep last night as I was hoping to. I know that those things kind of sound silly or mundane, but they really go a long way to your ability to really perform and come off well in a presentation and in a pitch. So when I talk about at this point, I have a very specific preparation routine that takes about 30 minutes prior to every pitch, where I literally walk myself through this almost pregame ritual just to make sure that I've got that consistency and I'm not kind of in a weird headspace
Yeah.
going into what is not an easy presentation, if you will. So
Yeah,
that stuff
yeah.
matters.
Juliana, on that note, have you ever walked away from an offer because the terms were terrible?
That's what we're going to get into is
Yeah.
negotiating. Great segue. Yeah, let's talk about negotiating.
Yes. So it is difficult because you as a founder, you want the money. Sometimes you need the money. But yes, ultimately the ability to walk away from a bad deal is the only leverage you truly have. And if you're not willing to walk away from a bad deal, then they don't need to give you a good deal, So you will occasionally get investors who that's their thing. They don't pay retail for good growing companies. Their thing is that, nope, they like to invest in more distressed companies, and then they help them kind of turn it around, but they get a nice entry point into this company. Like, that's a valid thesis. That's a valid investment thesis. So that doesn't mean that's right for me and my company, though. That doesn't mean that but there are some situations, especially in a market downturn, that maybe you didn't expect. If you need the money, you take the money, or you just accept the fact that you might go out of business. So
Well, in terms of that too, we're in a period now, we've entered into a period of, capital supply is low.
Yep.
So previous years, you guys were able to name your terms. We're like, oh, this is a great deal. Well, fine, we'll do whatever you want. Now, it's now the investors that are able to just say, we don't like that valuation. So we don't, we're gonna change some of the terms, and they're gonna be a little bit more favorable just because money is tough to come by. So we're gonna be a little more discerning. So it makes it a little tougher.
Yeah, but you
for
do.
you.
You have to have the discipline to walk away from a bad deal. And no one can really tell you what a bad deal is. You kind of have to decide that for yourself. But it's tough. It's hard. I mean, this
Yeah,
company's
and
your
I know some
life.
investors where, they want it, their job is to, or their goal is to pound down the founder and try and take as much of the company. And those are people you want to stay away from.
Yeah.
Because you want to, number one, good investors want to make sure that you have enough skin in the game and that you're excited every morning
Yep.
to keep building this company. But also, most investors know it's not a one and done. You're going to have other rounds. So why should you run and give so much of your company away right in the beginning? So.
Yeah. And really, that's why you as a founder, your goal should always be not one person who wants to invest, but multiple. Like ideally at the same time. It's hard to do. That's
Yeah.
not always, you don't always get that. But when we think about pitching 100 people, that's why I want to pitch all 100 in the same 30 days. If I'm spreading that out over time, it's very unlikely that one of those 100 are going to put in a bid the same time another one of the 100 do.
Well, sometimes you want to create that feeding frenzy too.
Exactly,
If we know there are
yeah.
a bunch of other people interested, number one, that's a good point.
Yep.
That says something good about the company, about the opportunity.
Yep.
But also, it gets us kind of competing to, on the deal
Yeah.
terms too.
So that's a key tool that we as founders use to combat the leverage that a single investor who might want to put distressing terms on us for. So it's kind of like our way of letting the market decide, but you have to move quick. If you drag out your round and it takes a really long time, it's hard to create that feeding
Yeah.
frenzy, as you say.
Yeah. Other questions? Yes, so there's a question back here.
So how does an early stage investor in some, say, a tech startup view some kind of affiliation with a university? Do they see that as adding complexity or too academic, or what's the attitude?
No, you know what? It depends, right? So if it's university, if the university owns the IP, the intellectual property, the investors have to be really clear what kind of deal you have with the company. Do you have like a perpetual license, on that if the university owns it? So that's an issue. The other is really going to come down to when you say a university affiliation, so maybe you can explain that a little better on.
Yeah, just everything from using interns, university students to code to something more formal engineering.
Yeah, so the question is, who will own it? If you're using university resources, an issue is then the university may own that. The other, if you're using interns to code, that might be good for MVP. I'm not sure it's going to give the confidence that you have a scalable platform that you're building. So early on, that may be great when you're doing your customer discovery. It's not confidence in building a company that can get big, because depending on the investors, if you're looking at angel investors, we want to make sure you're starting to put together a team in place that's going to grow with the business. Does that make sense? Yeah. Did you want to add anything to?
No. I mean, it's all about and governance as well, right? Like if they're
Yeah.
investing in you, is there secretly an institution behind you that's calling all the shots? Maybe.
Yeah.
Like,
Yeah.
what are we investing
And a lot
in
of
here?
it, you just don't want those lines. We want to make sure the company has the rights, if they don't own the IP, that they have the rights to the IP, and that you're building a team that will help grow, not just live in just that early stage of that. So, other questions? Yeah.
How important is the team when you're starting to pitch as a founder?
Do you want to talk to that, and then I'll give one?
Yeah, so in my experience, I'm the one who's expected to kind of be there through the process the whole way. Like my team, not maybe at the very end, the team kind of comes in and gets introduced to the investors, but the team is an important part of that story. So they may not be there in the room with you. Some founders choose to bring their people into the room with them.
Yep.
But for the most part, the investor typically expects it's the CEO and them and whoever's making the decisions there. But the team is important, especially depending on the company that you're building, right? Like if I'm building a tech company and I'm a business guy and I've never had tech
we want to
experience
see
in my
your
life.
We want to see your
Yeah.
CTO there
Exactly.
in the meeting to answer some of the
So
questions.
critical to the narrative, critical to the story. A lot of times, though, the actual presentation itself and the pitching itself is kind of one woman, one man show.
Yeah, and from the investor perspective, I know from Venture South, we look at maybe 10 different dimensions. The two that we weigh the heaviest, one's the team, and the other is the opportunity for an exit. And then there's a bunch of others, competition, things like that, right? But the team, you want to look to make sure, are there people on the team that know this space, that have experience in this space? And we want to make sure that that team really understands what they're doing. And it may be initially the founder, but later, as you're growing, as you're raising later rounds, we'll want to see, and we may actually, even in due diligence in a first round, we'll want to talk to other people on your team and understand, are they really good people? Or, and I don't mean good as in good or bad, but I mean, are they people that understand this space, right?
Yeah.
They should be good people, right? Good and ethical people, right? But do they understand the space? Do they bring experience? Or did you just hire your best friend, right? Who may not understand and is learning also.
Yeah.
So it's going to be important that that you guys have some ins to the knowledge that's needed to customers. So that team is important. But you don't have to have the full baked team, because a lot of times with the money, you're then going to be hiring that additional expertise.
All right, well, Dr. Juliana, Iarossi, and Josh, thank you both so much for coming up and talking
you,
about
everybody.
fundraising. Let's give them a big round of applause. Thank you.
Thank you.